Welcome to Keen on Retirement, a show dedicated to helping you thrive before and during your retirement years. If you are looking to grow and protect your wealth and want to make the second half of your life the best half, then listen in as Wealth Advisor Bill Keen sorts through the key issues that you need to know in a lively and candid way.
Hello, everybody, and welcome back to Keen on Retirement. I'm your co-host, Steve Sandusky, and with me are Bill Keen and Matt Wilson. Gentlemen, how are you doing today?
We're doing good, Steve. Happy early Thanksgiving to you, sir.
And same to you as well.
You going to be preparing for a big turkey dinner and all that kind of stuff?
Absolutely. Oh, yeah. This will be a lot of fun, and we are going to have all of our kids and grandkids here in our new home here in Portland, and very excited about that. So very much looking forward to that.
Nice. Very nice. Very nice. Well, I shared on a prior episode that we were early getting the pumpkins out this year. Chris has done a great job. We're enjoying the most of the seasons as we've been able to by getting the decor up early. So I know we were early decorators here at the Keen Wealth headquarters. For Christmas even, already have that up, and we're working on that at the house. Although, Chris, I really wanted to keep the pumpkins out as long as possible, so we're going straight from pumpkins to Christmas decorations here, and I think it's happening this week. I think the lights get lit. I think in the neighborhood, Matt, they told us on the Facebook page, no turning on Christmas lights before November 20th.
Yeah, there's some date.
Is that right?
I don't know why.
That they can control that?
I'm not sure.
Yeah, I guess people complain. It's part of having an HOA.
At the HOAs. I hope when I retire, I don't decide to get on the board of the HOA. What do you think? Anyway,
you'd be good at it, Bill.
It could be good.
Thankless job, I'm sure.
That's right.
Yeah. Very thankless. All right. Well, we have lots to talk about. This is post-election. We know who our new president is, and that means that we're probably going to see a lot of changes, and a lot of these will impact our listeners. And so we're going to go through some of the things that have been talked about here and discuss how those may impact each of you, particularly those of you that are in retirement or nearing retirement or thinking about retirement. A lot of these changes could impact you. So, Matt, why don't you kick us off? What's one of the first things we should be thinking about here today?
Yeah, we've gotten a lot of questions kind of post-election on, okay, well, what does this mean? It sure seems like the stock market is enjoying the result of the election. Stock market's been performing well. Steve, your favorite investment, Bitcoin, definitely been performing well. But some of the things that Trump campaigned on were very impactful to retirees or those that are close to retirement. And one of those being eliminating taxes on Social Security. This has been a very common question that we've been receiving throughout our review meetings that we've been holding here in the fourth quarter. And it's like, okay, that was something that Trump said while he was campaigning. What's going to happen? And is that good or bad? Because it sounds good, right? Eliminating taxes, but there's got to be some sort of trade-off, right? Because we have taxes on it currently. So I think it's helpful to kind of understand how the current system works. So currently, Social Security is taxed. There's a formula, and it's called the provisional income formula, and it looks at your adjusted gross income and actually adds back in what is considered tax-free interest. So it gives you a modified adjusted gross income, and you take that and you run it through this provisional income formula. And once your income gets over $25,000 if you're single, and about, I think it's $34,000 if you're married, then your Social Security becomes taxed as ordinary income. So when your income is below that, you don't pay any tax on Social Security. When your income increases above it, you start to have that count as ordinary income. Up to a maximum of 85% of your Social Security counts as income. 15% of it you receive tax-free. So even Warren Buffett, he's got his Social Security coming in. He still receives 15% of it tax-free. So if they eliminate taxes on it, okay, well then great. If I'm on Social Security, I don't have to pay income tax on it, which sounds good. But then what does that mean for the health of the Social Security program, the trust funds? We've heard nonstop that the trust funds are going to run out of money. 2034, I think, is the most recent number that I've seen. So we're within a 10-year window. And if that tax goes away, will that impact it? Well, it will, because the tax on Social Security pays directly into those trust funds, goes into the trust fund. So it's part of the operating account for when benefits are paid. So that would be a detractor from the income projections that are inside the trust funds, and it would speed up the point at which the trust funds are exhausted. So in that case, it's like, well, for a few years, maybe that's a good thing. And then ultimately, when the trust funds run out of money, am I going to get less? And that's definitely a possibility. May not happen. I mean, I don't think it's likely going to happen. I believe that Congress would act in such a way to not have that happen. I think there's enough voters who would not be happy with anyone who's in Congress that it would allow that to happen. Because what we're seeing is across the board about a 25% cut in your Social Security benefits if the trust funds were to run out of money. That's assuming Congress did nothing and just said, okay, we're going to just give everyone a cut across the board.
Well, I haven't heard any talk about investing the Social Security trust fund in the equity markets this go around, but that, I suppose, could be an alternative to some of the funds that are longer term out there. But anyway, that wasn't bantered at all. So it's easy on the campaign trail to come up with, on both sides, to come up with these ideas, right? But then the question is, it's once any party is in office, what does the policy actually look like? So I love the idea. Like you said, to open your talk there, Matt, there's a lot of folks that don't pay any tax on Social Security already. Quite a few, actually.
Yeah, and I think that percentage, I was trying to find that, because some of this data, while is easy to find, other components of it are not. But one thing I saw was potentially 40% of Americans don't pay tax on Social Security. So that would be 60% of Americans would benefit. Right. And I think another thing I saw said it would exhaust the trust funds. So current projections are 2034 based on how it works today. And I think something was set up to say it would be between 2030 and 2032. So anywhere from 2 to 4 years sooner by eliminating the tax on Social Security.
So we would have to come up with those solutions like we've talked about on prior shows, even before this was talked about at all during this campaign, to keep it solvent, more solvent, or completely solvent going forward for the long term. To accelerate those discussions, right? They'd have to come up with some of the things I think we might talk about even today on our show here that could fix that over and above having the thing invested in equities, which some portion of it would seem rational that could happen. But anyway.
Yeah. One thing that we would, they're common solutions. They're proposed by the trustees of the Social Security Administration to raise the full retirement age. It's currently 67. You can claim it as early as 62, delayed as 70. So raise that age at which you receive 100% of your benefits. That's definitely a possibility. People are living longer from the first point of when they instituted Social Security. So I think that's a reasonable solution. Especially if they target folks that are 40 or younger. Something like that. So we're looking at 30 years in the future of this actually being an adjustment. It's not something that would happen right away. Other things would be to change or eliminate the earnings cap. So right now, Social Security, the tax on your earned income is capped at a certain dollar amount, and that's per individual. So, married couple, if they both have earned income, they're both subject to that cap. But once you hit that cap, then you don't pay tax or Social Security tax on any of your earned income anymore. So raising that cap would be another a possibility. And those are two solutions that I think are highly likely because it doesn't impact the current beneficiaries. And that's, I think, going to be a very difficult thing to pass something that would take away from the current beneficiaries. And, they could come up with some solution that combines that along with eliminating the tax on Social Security. We'll see. As we know, a lot of times things are discussed while on the campaign trail and they don't happen. There's a lot of talk and not a lot of action, which is okay. That can be an okay thing. So we'll see how that shakes out. One thing that we have been seeing at the state level is states are eliminating state tax on Social Security. And right now, I believe there's only 11 states that tax Social Security. Missouri and Kansas are two of the most recent ones to eliminate the state income tax on Social Security. So I think some local governments think that retirees are leaving their states because of the tax situation, which is, definitely a possibility. So if they encourage retirees to stay by at least having favorable tax treatment on certain retirement benefits, then, hey, maybe they won't leave. I think the climate and other things have a lot more to do with it, but who knows? Who knows?
Yeah, and if they were to reduce, eliminate tax on Social Security as well, certainly. Okay, we already discussed that approximately 40% don't pay taxes already on Social Security, and it's because that's really their only income. And when we've talked about that before, which is why there's what I call a retirement crisis in our country, to helping folks be good stewards of their resources early, so they do have things more resources than just Social Security. But I would have to think, let's say that it starts to go through the process of being approved. There's no way that I would think that they would eliminate taxes on Social Security if you had adjusted gross income of, say, over $250,000 or something like that. So I think there would be some sort of I don't know if you would call it just a window of folks maybe that make from $40,000 to $250,000 that would benefit from no tax on Social Security at the federal level if it were to even get pushed through. But anyway, just speculating here as we await to see how these policies get enacted.
Yeah, another thing that was definitely something that Trump talked a lot about during his first administration, and then throughout the last 4 years while he wasn't in office, was interest rates. It is, I don't think, a secret that Trump is not a fan of the current Federal Reserve Chairman, Jerome Powell. He's made it known his views on where interest rates are at and what he believes about them. And ultimately what it means is that he doesn't believe that Social Security or that interest rates are in the right area, I guess, that I think he thinks it's impeding investment and different things by having interest rates as high as they are. So we'll see what happens with that. Now, one thing that is unique about the situation with the Federal Reserve is that the chairman of the Federal Reserve is, they're independently elected or selected by the president when that seat comes up for renewal, I guess. When that person is essentially their term is up, they can reappoint them, or they can decide to choose someone else, or the other person, the current person in that seat, currently Jerome Powell, can choose not to continue in that role. But I think most recent article that I've read is that Chairman Powell does plan to stay in that position and does not plan to just resign just because the current president-elect does not like him. So, I don't think interest rate policy would change significantly based on what Trump believes versus, what the Federal Reserve thinks is in the best interest of, our current economic policy. Because even if Powell were to step down and then a new person is elected, it's not just the chairman of that or chairperson of that gets to decide what interest rates are. It's a committee that's made up of a lot of people, and they determine what is the overnight lending rate, which is not what like government treasuries and other things are. They're I would say they're based off of it, but it doesn't determine what those rates are. That's determined by supply and demand. How much capital is out there looking for a place to park it, and when interest rates are higher, that potential capital that could be going somewhere else could be going into U.S. treasuries, which isn't necessarily a bad thing. That can be used to fight inflation and other things when there's a lot of capital out there chasing too few goods, raising prices higher, everything like that. However, when market participants believe that either the federal government is going to have a difficult time paying this back, then they may not prefer U.S. treasuries, which could raise rates, or market participants get fearful and think, well, wait a minute, maybe stuff's going to get really bad, and I just want to park some cash, and then a bunch of money goes into treasuries, which lowers rates. So that's how the market kind of controls interest rates versus what the Federal Reserve does.
What's kind of interesting here,
we've already reduced rates twice,
Mm-hmm.
so down 0.75% from where it kind of hit the peak. So we'll see what happens.
Well, I was just going to say, it's interesting that it was President Trump who actually appointed Jerome Powell
Yes.
to the Federal Reserve and was confirmed. And so, so he's Trump's guy, at least initially. And
Well,
so
and what
see.
this does is it proves, at least in this branch of government, they are an independent actor, and there's nothing Trump can do about it until their seat comes up for renewal. So even though Trump may not like him, he can't fire Chairman Powell.
Yeah. What also I think we don't talk about very much is, there's a level of interest rates where it's high enough that people are happy because, hey, I'm getting a decent return on my cash that's sitting at the bank or in a money market fund, but not too high that I can't buy a house because the mortgage rate is so high.
Yes.
And so there's really two sides to look at the level of interest rates. And of course, too high, and people may not invest in new activities if the borrowing money is a little prohibitively expensive and that sort of thing. But I think there's a lot of retirees who are sitting on cash and are happy getting 5% per year on their money market fund for their cash that's not invested. So that's something else that I think we need to keep in mind too. So when interest rates were down near zero and we were getting zero on our idle cash, a lot of people weren't happy about that.
Yeah, that's right.
We got used to it. I mean, we would make so little on our bank holdings that you wouldn't even get a 1099. Remember? I remember calling in over there to one of the banks, said, "Hey, I think you didn't send the 1099." I say, "Oh no, if you only made $1,
Yeah,
in
if it's
interest,
under $10, they don't have to send it.
$10,
Right.
is that it? Okay, yeah. But there's a lot of retirees out there would like to see their kids and grandkids, to your point, Steve, be able to go out and afford a reasonably priced home with a reasonably priced mortgage payment. So, and we might be getting close to that. Well, I don't know. I think we need to come down a little bit on the longer rates still at this point. I think we're still in the mid to high sixes on 30-year mortgages. I honestly don't know exactly, but I think that's about right. Maybe 6.5 right now, which historically is still pretty average, honestly. I mean, back when I got in the industry, we just always assumed, now it's 33 years ago. It's kind of funny. I say back when I got in the industry, it's getting longer it's going longer in the past.
Almost
Steve.
40 years now.
33. We would just assume a 10% mortgage rate back then.
Right.
The late 80s.
But,
in early 90s, late 80s, early 90s. Yeah.
And here's the thing. There's no free lunch in that when you talk about mortgage rates, for example, if mortgage rates are super low, if interest rates are super low, then what happens? The value of home prices goes up because it doesn't cost me much to borrow money to buy a house. And so prices go up. Okay. And then if interest rates are super high, what happens? Well, real estate prices will tend to come down because people can't afford them because the mortgage rates are so high. So there's no free lunch in there. And so we have to find what is that happy medium where Prices aren't, interest rates aren't so high that it dampens demand. It's not so low that it supercharges demand such that prices go up, way up, and that sort of thing. So, and the economy, left to its own devices, tends to find sort of that happy medium in there. But it's when the outside forces and different interests come into play that things can get out of whack. And that's why we see the pendulum swing from one extreme to another extreme over periods of time.
That's right. And Matt, I think you could correct me if I'm wrong on this, but what happened this time, Steve, to your point there, to that example, I don't think real estate prices actually came off that much in this last interest rate increase cycle because of inventories, and partially because of all the folks that are sitting on homes that normally would have been sold and put back into the market for resale were sitting on 2 3/4 mortgages. They didn't want to give that mortgage up. So there's a lot of the existing inventory was not offered for sale because no one wanted to let that 2%-ish mortgage go. So in this case, it made it even worse on our young people today because prices stayed high and interest rates went up. But again, that all works out, though. It all eventually works out in the cycle that you mentioned. But just unique things to take note of and learn from, I suppose, as we share with our listeners kind of our thinking and what we're observing as we travel this path together.
And just to tell you what a financial genius I am, I'm one of those guys who gave up a 3 1/8 mortgage rate to have the privilege to get a 6 1/4% mortage rate.
Oh, man. Okay. Dan, did you buy that down, Steve, or did you buy that mortgage rate down? You had to. I didn't.
I don't know. I paid a point or whatever, but
okay,
no, I didn't really. I didn't really buy it down. Okay. But yeah, I traded a 3 1/8 for a 6 1/4. So I'm going the wrong way there.
Well, let me tell you this.
But
Steve.
Hey, family's more important than my mortgage rate. So
exactly what I was going to say. My heart was singing for you when you talked about your future, your plans here for Thanksgiving with all the kids and grandkids, and so dollars. Hey, that's great. We could make a spreadsheet decision, but when it comes to being by family, it didn't matter what the rate was, did it?
Right.
Yeah.
Yep. Yeah, we're in a period of time where we've had higher than average inflation over the last few years. Now that is starting to slow down. We're seeing in the economic data that the rate of inflation has been slowing. So that's called disinflation. And so it doesn't mean prices are coming down. It just means they're growing at a slower rate. And currently, the previous 12 months, it's in the mid twos, which is where the Federal Reserve likes to see inflation, which helps them determine their policy when it comes to interest rates. So possible when inflation is slowing like it is, that they could see that as another reason to lower interest rates, which would help, definitely help from these mortgages and, other loans and anything like that kind of that are tied to interest rates. Now, one thing that we can see when it comes to home prices is that, maybe the rate of home prices is going to change. It's possible that home prices can come down without destroying the economy. That's definitely not something that we want to see, a crash in the housing market. So just so people can go buy homes, because that could be detrimental to the economy. But what we would probably like to see is a much slower rate of growth, or even, a slightly negative number in housing, where it's just, all right, houses are getting a little bit cheaper. I mean, one thing that I shared during our webinar in October was the median sales price, and that peaked at about $440,000 towards the end of 2022, and now we're sitting at about $420,000. So to that point, it's like we've had almost 2 years of almost stagnant home values, and that's across the United States. So that's looks at, the median. So it throws out the outliers aren't necessarily impacting that as much. But to see a flat number, even though the economy and the markets, stock markets are performing well, can be a way for home prices to at least get to a point where people can afford them at some point in the future, because they're not growing at the same rate that they have been. Funny enough, now we've had this kind of 2-year period of basically, 0 to negative home price growth. Well, October of 21, so a year prior to that, we had a 22% year-over-year increase in home prices. So it was preceded by a significant increase in housing values, and hopefully get to a point where housing does become affordable, because it is a big expense for a lot of folks.
Well, I was just doing a little calculation here, and so home prices has been obviously a big issue here in recent years as it's become unaffordable for many people. But what's also interesting is if you look at the number of people that own homes that have benefited from the increase in housing values, there's approximately, if this data is correct that I'm looking at, about 142 million homes in the United States, housing units. Now, I don't know if that includes apartments or whether that's single family homes. I'm not sure. And then there were about 4 million existing homes that were sold and another, let's call it 700,000 new homes. So let's call that 5 million home sales in a year. So there's, more than 20 times as many people that own a home that are benefiting from the increase in the home value that contributes to their increasing net worth relative to, let's call it the 5 million people that are starting to get priced out of the housing market because prices go up. So for every, in anything, for every winner, there's a loser, or for every loser, there might be 10 winners or 20 winners. And so I always think we've got to think about like all the participants in any of these decisions that are being made, whether it's interest rates, whether it's, whether we're going to drop taxes on Social Security. It's like all these decisions generate winners and losers. And I think there's always this constant back and forth between who's winning and who's losing, and who are the special interests that can influence who gets to win and who gets to lose. I guess that's why it's politics, right?
Right.
But yeah, it's interesting when you look at some of the details here of how these numbers shake out, that when housing prices went way up, there's a lot of people that have made a lot of money from that.
Yep.
While at the same time, there are people who were hurt because they're priced out of the market. So it's, I think we need to, keep all that in mind as we think about, what decisions are being made here.
And you think about, to your point, people who have participated in the benefiting from in the inflationary environment. You know who else participates during the inflationary environment? We talk about it all the time as one of the biggest risks for a retiree entering into a 30-year plus retirement if they're not invested with the appropriate amount of equities in their portfolio. I'm not saying 100%, but I'm saying some investment in equities or the great American companies or the great companies of the world. Stockholders also benefit during inflationary times. Stocks go up as well during inflationary times. So just a side note to that, owners of assets benefit from those things.
That's right.
Yep.
Yeah.
Very good.
Well, one of the last things that was, we've been talking about this a lot over the last several years, especially our one-on-one meetings with our clients, is just maximizing their current tax situation or optimizing it. And what that means is, we like to, on an annual basis, just run through a mock kind of tax return with all of our clients and run these what-if scenarios to look at, okay, well, let's do our best to estimate what we think your lifetime tax liability will be and figure out, is there a way for us to reduce that? And a lot of people like that concept. Hey, if I can pay less taxes, great. Well, how can we do that? Well, that can be via Roth conversions. It could be, even if you're still working, ways to utilize the current tax code via maximizing your current pre-tax contributions, because you might be in a lower bracket kind of post-retirement. Also, if you're in a low bracket currently, you might be in a higher bracket in retirement with RMD. So how do you kind of look at that? Maybe you should put more in your pre-tax Roth IRA, Roth 401k if you're contributing to that while you're still working. A charitable giving too is another strategy that we can look at to minimize someone's lifetime tax bill. Well, we've been in this period since beginning of 2018 where we've had lower tax brackets with a expectation or a known sunset of those current tax brackets. So meaning, well, at the end of 2017, when Trump was in office, he passed, and along with Congress, the Tax Cuts and Jobs Act, which lowered taxes for just about everybody. And those are set to sunset at the end of 2025 at the personal income tax level. And it's highly likely that that's not going to sunset now, just with Trump winning the election and where the current makeup of Congress is looking, and highly likely that they're not going to, they'll be able to continue that in the way it sits. Now, doesn't mean things won't change. So one of the things that Trump campaigned on, and this was part of the Tax Cuts and Jobs Act, they talked about this a lot back then, was the SALT deduction, or SALT, the cap on it, which is the state and local tax. That's what SALT stands for. And prior to the Tax Cuts and Jobs Act, you got a tax deduction for all state and local taxes that you paid. Was no, cap on that. And, the thought process around putting a cap on it was that, well, these high tax states or high tax areas are being supported by everyone else that's in a lower tax. Because if the federal government is giving them a credit for the state and local taxes that they're paying, it's like you're subsidizing it with federal income tax from other areas. Well, it passed with a $10,000 cap, and Trump has now campaigned on eliminating that cap because most people would just prefer a tax cut, and that would be a tax cut for a lot of income taxpayers by not having that cap, because that cap wasn't adjusted for inflation. So a lot of people are hitting it even quicker because property taxes went up, and if you own real estate, your real estate taxes most likely have gone up. Your premiums associated with your homeowners, all those costs. Now, you don't get to deduct those premiums, but everything related to real estate is going up in costs. And that cap, that SALT cap of $10,000, was getting hit by a lot more people than when it first was put into place. So I think that is likely to be reviewed. And sure. I don't know if it'll be eliminated, but maybe the cap would be significantly higher.
And Matt, that includes state taxes, like state income tax, right? Mm-hmm. That you pay income tax. So you pay your taxes every year, and if you're working and you're a W-2 employee, mm-hmm. you see your federal and state withholdings. Before the SALT tax went into play, you pay, whatever you pay on your state to income tax, you could deduct it off your federal return.
That's right.
Seems reasonable. Kind of like double taxation, anyway. So they, like you said, cap, and that's personal property tax as well. So all that mm-hmm. on your house, and so you put all that together and cap it at $10,000. Yeah, it wasn't a huge number, was it? The cap. So
that's right.
Really hit the people on the coasts and and those kind of things, and others just higher income people, pretty quick.
Mm-hmm. Mm-hmm. That's right, because it really, a federal tax bill that gets passed doesn't impact your state taxes. So if even though they change certain things at the federal level, doesn't necessarily flow down to the states. So, in some cases, some people may have actually ended up paying more taxes because maybe they had a high state tax bill and they were getting a significant deduction that now was eliminated. It wasn't necessarily common for a lot of folks, but definitely one of those things that happens. The other kind of provision of the Tax Cuts and Jobs Act, which was not set to expire, was the change in business income tax. So it was dropped from 35% down to 21%, and that did not have a sunset provision tied to it. So I think there was some thought people thought that was the case. That was not the case. So that there were some pieces of it that were set to expire, but the overarching kind of theme of lower business taxes was something that Congress would have had to act independently of this expiration of the Tax Cuts and Jobs Act to change that.
And didn't Trump campaign on trying to lower the 21%?
I believe so. Yeah.
Yeah. Which sort of begs the whole question, and I think we've addressed this in previous episodes, of who's going to pay for all this? Does it need to be paid?
It may not.
When will it make a difference, if ever? right? Because, for decades, we've always talked about the budget deficit and we got to reduce the deficit and that sort of thing. And regardless of what administration was in power, they both were running up big, big deficits. And there hasn't been huge pushback in recent years on these big deficits. Do you envision that changing at all, or do you see this trend of ever larger budget deficits accelerating in the future?
Yeah, it's an interesting kind of thought process, because it's like, well, the capital has to go somewhere. When people, businesses, entities, are trading goods and services, it's like, well, the money, gets traded in currencies, and then those currencies get exchanged. A lot of times the financial markets, and more specifically like the government debt markets, so like the U.S. Treasury market is the largest in the world, which supports a lot of the global trade because our financial system is large enough to do that. Someone, China could say, hey, while yes, we own U.S. debt, it may not be really that significant of a portion of the overall total. I mean, most of the debt that the U.S. has is owed to the people of the U.S. via
To itself,
Social Security and Medicare. I think the last number I saw was over 50% or close to that was kind of owed to ourselves through those future obligations. But if China said, okay, to heck with the U.S., we're going to put it all in Switzerland, well, they have too much money. They would own every single Swiss debt instrument that ever existed. So it's not possible for them to go do something else to a certain extent. I mean, you can't bank on that, but there is restrictions that are created that just doesn't allow for other solutions. There's this talk of maybe some sort of type of cryptocurrency. So that's definitely something that could impact the U.S. if there's some transition to whether it's a multi-currency backed crypto instrument, who knows? I mean, you'd still kind of have to have central banks to figure out how all that would work with each other. So there's a lot of nuance to that I don't think it's just going to be an easy solution. I mean, one of the things that the former head of the Federal Reserve, Janet Yellen, she suggested minting $1 trillion coin. Let's just put all the debt on this coin, and this, I don't know what you do with the coin, shoot it off into space, but sit there and stare at it. That owns all the debt now, and you wipe the slate clean. So to your point, Steve, it kind of makes you think, well, if that's the solution, it sure doesn't seem like the debt really matters.
Until it does, if ever. It's like, we thought 40, 50 years ago, back in the 80s when Reagan was president and everybody was complaining about, budget deficits back then. And today, obviously, we're many multiples beyond what it was back then. Of course, our economy has also grown
That's right.
dramatically too. So as the economy grows, it has the ability, if we're thinking in traditional financial terms, to support more debt.
That's right.
But the debt has definitely grown faster than the economy has grown.
Yes.
As well. So, yeah, it'll be interesting to see. We talk about these bond vigilantes. Now, Matt, why don't you tell us what bond vigilantes are? We haven't heard about them too much in recent years.
Yeah. I mean, my I guess definition is they're the ones where I talked about market participants, whether they want to own U.S. Treasuries or not want to own U.S. Treasuries via the auctions that exist, which controls interest rates. Well, the vigilantes would be the ones that are saying, no, the debt matters. We're not going to buy these bonds and we're going to raise rates. It sounds like it's like some group of comic book villains that are out there just trying
some nefarious group out there.
Yeah.
The bond vigilantes.
But really, it's the collective thought process that, well, wait a minute, this debt's unsustainable and we don't like it. And all of a sudden, it starts to be a thing that is talked about. We've had this discussed in the past. The rating agencies that come up with bond ratings for corporations and for governments, they've come out in the past and they've lowered the U.S. government's credit rating. So those are things that, someone could say, well, that's a bond vigilante type move to say, hey, wait a minute. No, you guys got to start thinking about this, and because it does matter. And did that really do much? At the moment, maybe, but in the grand scheme of things, no. That did not matter when they changed the rating of the U.S. debt.
Just for fun, during Reagan's presidency, federal debt held by the public nearly tripled in nominal terms from $738 billion. So that would have been the federal debt, $738 billion to $2.1 trillion over that time frame. So that was
the cumulative debt, correct?
That's correct. Yes.
Yeah. And now in 1 year, we have an annual deficit that's even greater than what it was the cumulative debt during Reagan's era. Is that right?
I believe so.
We've had annual deficits, what, 2-3 trillion, right?
Mm-hmm.
That's right.
Yeah.
Now, one thing back then, interest rates were significantly higher, so it did encourage people to park money in treasuries. I mean, you could get high teens, I believe, in the early 80s in 30-year government bonds. So not that was probably a big, a lot of people were purchasing them, but that encouraged people to go buy treasuries, which does increase the debt when that happens.
And we can't look at something just in a vacuum. So we have to, anytime we talk about national debt, we've got to talk about GDP growth, which is kind of the output, short definition of the country. So real GDP during Reagan's presidency grew over $2 trillion as well. So the compound annual growth rate of the GDP was 3.6% during Reagan's 8 years, comparing to 2.7 the previous 8 years. So like we see kind of a walking in step. Now the ratio is something that we do follow. So again, probably a whole other episode on some of these economics data that we're talking about, or simply tune into Matt Wilson's quarterly economic outlook.
That's right.
Nice segue, Bill.
Oh, yes.
All right. Well, guys, another great episode here. Lots to talk about, and appreciate you taking some time today. So for each of you listening, please make sure that you tell your friends and colleagues about the show. We'd love for them to subscribe to it. And if you want to get all the details for this episode, please go to keenwealthadvisors.com, and you can get the show notes as well as all the other great blog posts and content that we have out there. So again, guys, thank you. And we'll look forward to the next episode of Keen on Retirement.
Thank you.
The Steve Sandusky Advisor Network and Belay Advisor are not affiliated with Keen Wealth Advisors. Opinions expressed by Steve are his own and not necessarily the opinions of Keen Wealth Advisors. Keen Wealth Advisors is an SEC-registered investment advisor. Advisory services are only offered to clients or prospective clients where Keen Wealth Advisors and its representatives are properly licensed or exempt from licensure. The contents of this podcast are intended for the residents of the United States of America. No advice may be rendered by Keen Wealth Advisors unless a client service agreement is in place. This program is intended for informational purposes only and should not be construed as advice on or a recommendation of any particular investment, strategy, or as tax or legal advice for your specific situation. Keen Wealth Advisors is not a tax or legal advisor. To determine which investments may be appropriate for you, consult your licensed professional prior to investing. Information in this program was compiled from sources believed to be reliable. Due to the constant state of data changing, we do not guarantee the timeliness or the accuracy of the information provided. Our views or opinions at the time you are listening to the podcast may be different than they were when the podcast was recorded. Past performance is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. Any prices that are referenced or market forecasts are as of the date stated and are not necessarily our opinions moving forward. As always, please remember, investing involves risk and possible loss of principal capital. This podcast is not allowed to be copied, distributed, published, or reproduced without permission from Keen Wealth Advisors.